Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Perpetua Resources.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Yeah.
When you first look at Perpetua, the most critical thing to grasp right off the bat is its status. This is a pre-revenue development stage miner. You just can't analyze it like a standard operating business.
Right, and that's the trap, isn't it? So many investors pull up the P&L statement, they see the red ink, and they just, move on immediately.
Exactly. I mean, if you look at the trailing 12 months, the company's net loss is approximately, $22.1 million? And that translates to a negative EPS of minus 31 cents. But for you, the person really paying attention, this isn't a sign of some kind of operational weakness.
No.
It's the cost of doing business. It's the anticipated cost of building a massive, very complex project.
So that $22 million loss, that's basically the price of admission they're paying right now to get this mine permitted and shovel-ready.
Precisely. Value creation here, it doesn't depend on near-term profits at all. It's entirely about driving up the net asset value, the NAV. They're pouring capital into de-risking the Stibnite Gold project, moving it towards construction, and every step they take drives up the future worth of what's in the ground.
That makes a lot of sense. So the stock is really a bet on execution, not on current cash flow. But, there are hundreds of junior miners out there all focused on gold.
Right.
What makes Perpetua so different? What's the real hook for the street right now?
The hook is what we call the strategic dual asset moat.
Yeah.
It's where geology gets tied into geopolitics. See, the Stibnite Gold project is set to be a major U.S. source of gold, which is great on its own.
Sure.
But the real scarcity, the thing that changes the entire story, is the second asset.
Antimony.
Antimony, right, the critical mineral. So that's the factor that really shifts this from just another commercial mining story to a national security story. It's the absolute game changer. Antimony is vital for defense applications. We're talking everything from munitions to specific military batteries, flame retardants.
Okay.
And the big problem is that the U.S. is heavily import dependent for it.
And often from places that aren't exactly our allies.
Precisely. From geopolitical rivals. That creates a huge supply chain vulnerability.
So this project basically solves a major national weakness. You've got a Tier 1 gold deposit sitting right next to the only identified domestic antimony reserve of its kind. That creates a kind of policy-driven moat that you just can't buy with money.
And here's where it gets really interesting. That competitive moat is being actively built out by government partnership. Perpetua has this high-profile partnership with the Idaho National Laboratory, the INL, to build a pilot plant.
And this isn't just about proving they can dig this stuff up, is it? This is about meeting a very specific standard.
It is entirely about certification. The plant's purpose is, 1, to recover antimony and other critical minerals from the ore, but 2, and this is a key part for the Department of Defense, is to prove they can produce military-spec antimony trisulfide.
Okay, wait, why is that distinction so important? Why can't the U.S. just buy industrial-grade antimony and use it for munitions?
It all comes down to reliability and purity. Munitions demand an incredibly high, consistent grade of antimony, that military spec. You can't just buy that on the spot market.
I see.
If the antimony component fails, the entire munition fails. So this partnership, it's designed specifically to qualify Perpetua as the trusted defense-grade source.
So they're moving from being a simple commodity seller to a certified integral part of the U.S. defense industrial base.
And that directly supports the U.S. Army's stated goal, a fully domestic, ground-to-round antimony supply chain. This alignment, it positions Perpetua as a preferred source, and that creates a very powerful demand floor for their antimony.
And a lot of unspoken political backing for the whole project. That must be huge for de-risking the permitting process.
It fundamentally changes the odds.
That government backing sounds like a serious de-risking event. But speaking of de-risking, let's talk about the balance sheet. A project this size, it always faces huge funding questions. What's the status of their capital stack?
Well, we've seen a real step change in their funding capacity just recently. In 2025, they completed some significant capital raises, pulling in about $382 million in gross proceeds.
And who is underwriting this? Who's putting up the cash at this early stage?
The names are what matter. First, you have a strategic equity investment from Agnico Eagle.
A major producer.
Exactly. A massive established peer validating your resource by buying a big chunk of your stock. That sends a powerful signal.
And the second one.
Even more telling, a major investment came from the JP Morgan, the $1.5 trillion National Security Fund?
A national security fund. That's a huge stamp of approval. It suggests they're looking at this not just for ROI, but for strategic stability.
It's a different risk calculation entirely. And then you have the debt side, which is just as impressive. The U.S. Ex-Im Bank has issued a preliminary project letter and an indicative term sheet for up to $2.80 billion in project debt financing.
Wow, $2 billion. That's basically the U.S. government saying, we will help you finance this because we need the output.
It's a material step change. It massively lowers the financing risk and, it strengthens their bargaining position with everyone else. The market is validating the project's importance by lining up this kind of capital.
Okay, so the money is there, the political will is there, but you still have to actually build the thing. Execution matters. What's happening on the ground right now?
Progress is already underway. They've started what they call early works construction at Stibnite. That began back in October of 2025.
Early works.
Yeah, things you need to do before the main event. Site prep, access road upgrades, environmental controls, water management.
So starting that before the final investment decision, the FID, that signals a lot of internal confidence. They must feel good about hitting that spring 2026 target.
It seems so. And they're backing it up with people. They've been expanding their leadership team, brought in a new senior VP of projects. It really signals they're staffing up for the massive construction phase.
And the price action, I imagine, is reflecting all of this optimism.
Oh, absolutely. The stock has been on a strong rally over the past year, up roughly 133%. The 52-week range tells the story. It's moved from lows around $8 to highs up past $44.
And technically speaking,
the structure is just a classic bullish trend. You've got the short-term moving averages above the medium term, which are above the long term. Clear, sustained buying pressure. It's not just a short-term frenzy. And what's fascinating is the institutional conviction behind that buying.
Who's holding the stock?
Institutional ownership is very high, around 70% of the float. This signals really strong sponsorship from the big players.
Any names that stand out?
Well, Paulson & Co. significantly increased its stake. It's now their second largest holding. When you see specialized resource funds like that, or a major like Agnico Eagle actively adding, that provides some pretty robust smart money validation.
Okay, this all raises the important question, the counterpoint. We have to talk about the bear case. What could derail this? What are the risks, especially on a multi-year timeline like this?
Well, the primary risk is, and always will be, execution, permitting, and timeline risk. The entire valuation is concentrated in the successful, on-time, on-budget completion of Stibnite.
So any permitting delays or big cost overruns could really hurt the NAV.
Materially impacted, yes. And a second related risk is funding and dilution risk. That $382 million is great, but the total project is in the billions.
Right.
They still need to finalize all that debt financing. If capital costs rise or timelines slip, shareholders could face dilution down the road.
And you can't ignore the commodity prices themselves, gold and antimony.
Right, that's a secondary risk. But it's always there. A sharp downturn in precious metals would certainly impact the project's economics.
But there are some pretty powerful mitigants to those risks, aren't there?
There are. Mitigant one is the strategic nature of antimony. The explicit U.S. Army interest significantly lowers the probability of an outright project cancellation. It basically makes the government a partner in its success.
That political alignment is a kind of insurance policy.
In a way, yes. And mitigant two is their operational discipline. The fact that they have zero lost time incidents, no reportable environmental spills, that suggests competent management and that they're aligned with the regulators, it mitigates the most severe execution risks.
So putting it all together for the listener, what we have here is a high-risk, high-reward story, but one anchored by a really unique strategic value. What's the final takeaway?
The core pitch is this. Perpetua Resources offers leveraged, asymmetric upside to a strategic gold plus critical mineral asset, and that asset is tied directly to U.S. national security policy.
And the timeline here is key. This is not a stock for, short-term trading.
No, it's best seen as a multi-year hold. Think 3 to 5+ years, right through that final investment decision and into initial production, probably in that 2026 to 2028 window. The value gets re-rated higher with each de-risking milestone they hit. The key is recognizing that while the near-term earnings are negative, this is a stock trading on geopolitical optionality and de-risking milestones. The question for you, the investor, is whether you are willing to underwrite that execution risk for the potential multi-year asymmetric upside inherent in a defense-backed critical minerals platform.
Exactly. If you want to follow us as we track the progress of the INL pilot plant and those critical financing updates, make sure you hit that subscribe button. We'll be back tomorrow with another Smart Wealth analysis.